Our research team has recently completed new research for the Center for International Finance and Regulation. The title of our paper is Fool's Bait: What Does Chess Tell Us About Individual Investor Trading Performance? We believe our work will be of particular interest to an Australian audience, including investors, brokers, and regulators. This is why we decided to publish the work in an Australian-based journal, Accounting and Finance. The trading performance of different types of investors is of increasing interest in terms of market design and in order to direct regulatory policy. Our research question in this paper is: how are individual investors performing compared to large investors who are well-resourced, professional, and often foreign? This happens also in an increasingly technologically driven environment. In this investigation, we identified traders using chess clearinghouse data. This means that the trades we analyze are for investments that are held for at least 1 day, as intraday trading never reaches the clearinghouse. We identified 3 main investor categories: individuals, households, institutional investors, and foreign investors. We identified those stocks that individuals buy intensely and those stocks that individuals sell intensely. We then analyze how they perform after the purchase. Similarly, we identify those stocks that foreign institutions buy and sell intensely and compare the results to those of the individual investors. We find the following results. The y-axis shows the cumulative returns adjusted for market return, and x-axis shows the days since the intensive trading by individuals has occurred. Intense buying is followed by approximately 0.5% negative return, while intense selling is followed by approximately 0.5% positive return. Following the trading by individuals would result in a zero-cost portfolio that underperforms. These returns do not fully reverse. When we focus on the 3 days after a trade by an individual investor, the aggregate difference in return between stocks they sell intensely and stocks they buy intensely is, during the first trading day, almost -1% for small, 0.8% minus for medium, 0.7% minus for large market capitalization stocks. The same figure for foreign investors looks like this. Foreign investors outperform during day 1 to 3, and their trading appears perfectly opposite to the trading of individual investors. We find that individuals typically underperform in the short term, with stocks they buy falling in price by approximately 0.5% over the 3 days after the purchase, while stocks they sell increase in price by approximately 0.5%. This result is highly significant statistically and economically. In conclusion, what are the possible explanations for what we have uncovered? It is not caused by individuals placing aggressive trades. Individuals trade patiently, in fact, waiting for the market to come to them. It's also not caused by compensation for individuals providing liquidity to foreigners, which is contradictory to the previous literature. If this was the case, the shares individuals buy would go up in price for a while at least. This is an information asymmetry story. Foreign institutional investors appear better informed than households, which urges the foreign institutions' persistent outperformance in the intermediate term. This may change if one analyzes the full economic cycle of boom and bust, as individual investors typically follow more long-term investment strategies. This justifies the actions of the regulators and exchanges in promoting market design rules that better protect less informed investors. One area where this may be achieved is by providing greater transparency in relation to the identity of trading counterparties. These findings are important because they to areas where markets can be further improved so that individual investors are not disadvantaged in comparison to better resource investors. Individual investors are an important source of equity and debt capital for corporations, and hence it's good policy to attract such investors to the market.